Get to Bob Pisani. Hey, Bob.
You don't normally see this, Carl. Dow up 0.5%, the S&P down 0.4%. As you mentioned, that's because banks and oil are pushing the Dow up. Dow is price weighted. Goldman's $400, having a big day. That's pushing the Dow up. S&P is down because Apple, Microsoft, Cisco, just to name stocks in the Dow Industrials that are tech, are pushing the S&P down because it's market cap weighted, and the market cap where it matters is tech stocks in the S&P. So interesting little index weighting lesson here about how these two indexes are very, very different. Here's the sectors. You see the nice move up in energy stocks, having a good year overall. Banks finally starting to move in the last few days. They've been sideways for months. Materials is part of the global growth story that's really moving things. So this story today is about higher rates and the global recovery. There you see tech lagging, and that's because of the concern about higher rates. We had this movie before, remember, back in January and February. So there's your number one story, higher rates and the global recovery overall. There are some concerns, vague concerns over the weekend. I got these notes, shades of 2011 when the S&P downgraded the U.S. Debt rating because of concerns about the debt ceiling drama back then. I don't think that's going to happen now, but there are vague concerns still going on. Those supply chain concerns are very, very real. I think Nike was a big story last week, and China Evergrande kind of fading a little bit as a major issue. But just take a look here at Nike. Remember, Nike's down about 7% from the earnings that they had. The bulls are continuing, the global bulls are continuing to say, guys, they said business is great. Vietnam is going to come back online. Indonesia is going to come back online. All this is going to go away, probably, but it's taken a lot longer than people had thought even a couple of months ago. So the bulls are right. It is going to come back online, but the bears have been right, too. This has taken a lot longer than people anticipated. You see Nike down here today. Great that oil's breaking out. $75, that's a really important level. We haven't broken out on oil. This would be a major breakout. We haven't been over $75 consistently on oil since 2014, 7 years. So this is a very major level for oil right now. And even for energy stocks are still negative compared to 7 years ago. If you would have invested in the S&P Energy Index right now, you'd still be down 3 or 4% if you would have bought it in 2014. That's how bad it's been. Now, energy's having a great year this year. It's great to see some of these big exploration production companies like Conoco move up, and Occidental. These are great years with the S&P up 18. Even Exxon is up 40%. But it's been a long, slow road. And as we keep pointing out, nobody owns energy stocks anymore. That's why it's not moving the S&P 500. Why isn't this reflected? Because it was 2 or 3% of the S&P 500. That's how bad energy got in the S&P. So we keep reminding everybody that what matters is technology. It's 40% of the S&P, 27% in the index called technology, but communication services is essentially technology as well. So put it together, it's 40%. Healthcare, which is a growth sector, that's the other major group. There's consumer discretionary, there's financials, and energy is 3%. And folks, 3% energy, that's with the rally that we've had. It was 2% a few months ago. So it's wonderful that energy is breaking out. But in a world where everybody owns indexes, Carl, this is a very, very tough situation to watch. You've got to be buying energy stocks, and nobody owns those energy stocks individually, at least not anymore. Maybe it'll start a fad then. Who knows? Energy may make a comeback as individual ownership, but not in the S&P right now.